So you might have noticed that pretty much everyone, everywhere, is freaking out about everything. Everything related to the economy, at least. Recession fears, egg prices, tariffs are on, tariffs are off. Another burgeoning housing market collapse, stock market volatility, interest rates, defaults, leverage, overnight settlement markets, liquidity, weak dollar, strong dollar, crude oil collapse, repo markets, stagflation, deflation, inflation, disinflation. We've managed to confuse the global markets, to crush long-standing alliances, unwind trade deals that we wrote, and somehow even piss off Canada. But there's one topic that surfaced over and over in the news last week that trumped even Trump.
The more telling signal of the coming financial calamity can be found in the bond market.
But you can see here that U.S. Treasury yields skyrocketed this week as investors sold U.S. bonds.
The evidence would suggest that global investors are beginning to question, how AAA is the United States.
Imagine a whitewater river of incoming cash coming into the United States, just violently reversing and going the other way.
Just as we all became epidemiologists during the pandemic, everyone is now an expert in markets, tariffs, and trade. But last week, even armchair warriors were pretty quiet, because the financial channels were filled with news about the bond market and how the yield on the 10-year Treasury somehow foreshadowed the end of the American empire. Pundits everywhere were misusing the phrase full faith and credit, talking about calamitous inversions, the flight to safety, negative correlations, and if the US dollar is at risk of losing the privileged status of the world's reserve currency. So if you're wondering what the fuss is all about, I got you. We're here to break it all down. Tell you what's real, what's hyperbole, if we are headed for a collapse, and why a bunch of nerds from the bond desk are having their moment in the sun. UNFTR. If you're new here, I'm so happy that you joined. If you stick with the video and you like what you see, just like it and then subscribe to the channel. Doesn't cost a dime, but it helps us out tremendously. Please do also leave questions and comments below because it helps us build content around your interests and questions. We also publish a free weekly newsletter every Saturday covering top news stories, an economic chart of the week, book and podcast recommendations, and more. Just go to unftr.com to sign up for the fastest growing progressive newsletter in the country. We'd love to keep the conversation going. Now back to the topic at hand. The idea of the United States going bankrupt is like science fiction to most of us. Now, there are always chicken little pundits that talk about the size of our debt and how it will eventually lead to the collapse of the United States and bring the global economy to its knees. Well, the reason this hasn't happened, despite the fact that the national debt is now $36 trillion on a budget of $7 trillion, is because we print our own money. And as importantly, because our economy is so big and historically powerful relative to other countries. Which ones, you ask? All of them. The value of that dollar that we print has been relatively stable. In fact, if you're of a similar mind to Donald Trump, the dollar is too damn strong. He's been on that hobby horse forever, especially when it comes to China. But more on Trump and his obsession later. Let's talk about the strength of the dollar, how we profit from our debt obligations, and what the hell this has to do with the bond market. Okay, so we're going to get into the economic and financial weeds shortly, but there's a political point that undergirds this entire discussion. Section 4 of the 14th Amendment, there's a clause that states, quote, "The validity of the public debt of the United States, authorized by law, including debts incurred for payment of pensions and bounties for services in suppressing insurrection or rebellion, shall not be questioned," end quote. In other words, we will, in every case, to any debt holder, honor our repayment obligations. So, funny story. Most people are aware of the 14th Amendment because it passed on the heels of the Civil War, and it contains seminal principles like citizenship, equal protection, due process, the insurrection clause, and the enforcement clause that gives the Congress power and authority of enforcement of all of these things. And yeah, there's a bit about public debt not being questioned, but to be honest, no one really talks about that one. So in addition to epidemiology and global trade and tariffs, let's add constitutional scholar to our list of expertises. In just a matter of weeks into this presidency, Donald Trump has destroyed every single one of these provisions. So why, oh why, would you think the U.S. making good on its debt obligations would be the only one that remains sacrosanct? That's how all of this relates to our first point here. The world sees us. It sees what we're doing. They know that we're disappearing students and visa holders from the streets and sending them to prisons designed for terrorists. They see Trump trying to sell Teslas on the White House lawn. They're weirded out by the whole Gulf of America thing, threats to overthrow Greenland, yelling at world leaders that we supported a minute ago, and cozying up to Vladimir Putin, the most reviled man on the European continent. They see him dismantling government agencies, and they watched the tariff press conference and also said, "What the f***?" So before we get into wonky economic discussions, understand that the rest of the world, which includes investors, sovereign wealth funds, multinational corporations, hedge funds, and global trading desks, thinks that we're sliding into a dictatorship. Forget recession talk for a moment. A U.S. dictatorship is way worse in their minds because it means everything is subject to the whim of a madman, including the repayment of our debts. He has literally ripped up the rest of the 14th Amendment, so why not that as well? You dig what I'm saying? No one wants this. I mean, they look at us and say, they put the guy in charge who bankrupted the Trump Taj Mahal in 91, Trump Plaza Hotel, Trump Castle and Trump Plaza Hotel and Casino in 92, Trump Hotels and Casino Resorts in 2004, and Trump Entertainment Resorts in 2009 for nearly $7 billion all told, along with folding Trump University after it was found to be fraudulent, and Trump Steaks because, admits to evading taxes, violated the emoluments clause over and over again, committed adultery, perjury, and was convicted of a felony. Doesn't inspire investor confidence if you also know that he's willing to break every constitutional amendment and no one can seem to stop him. You cannot take this man out of the equation because he's trying to overthrow the government from within and declare himself a monarch, and we're like the only ones who can't see it. So with that, let's get wonky. Here's what economists and market observers were freaking out about. I'm about to show you two charts and point to the very small, very specific moment that everyone lost their shit last week and what they're all going to be hyper-fixated on in the coming months. Forget about inflation, interest rates, loan defaults, or any of that good stuff. Even stagflation takes a back seat to what I'm about to show you. So this first chart is a look at the yield on the 10-year Treasury, which I'll explain in detail in a moment. Now you'll notice that it hasn't been this high since the run-up to the financial crisis and the peak of the inflation crisis under Biden. But what I want you to notice is this tiny little uptick at the very end, right here. Got it? Okay, hold that thought. Now let's look at the value of the US dollar. I'll put it just below so that you can see them together. You can see that they are positively correlated. So when the dollar is strong and rising, the yield on the 10-year Treasury typically follows suit. Now look at the same small piece at the very, very end. Last week, when the bulk of the tariffs were theoretically still going to happen, these two trend lines separated for a minute. That was it. That was the big panic. So if you're sitting there right now going, what's the big deal? You are certainly right to ask that question. To answer what the big deal is, or whether it even is a big deal, we have to do a little housekeeping to understand why this spells disaster in the minds of economists. So I'm going to set the table with a little history, and then we'll unpack some definitions. You know, on this channel, we've talked a lot about Bretton Woods, the conference in 1944 that established the new global monetary and economic order in anticipation of the end of World War II. But we should go back even further to incorporate the 14th Amendment to understand the importance of central banking and monetary stability as well, because Bretton Woods will make more sense in that context. In fact, if you go back to our founding, there was already a tension between the founders, between the Federalists and the Anti-Federalists, over the notion of even having a central bank. So proponents on the Federalist side believed that the only way that we would have the strength to defend the nascent republic against future wars and also be able to pay off the debt from the revolution was to issue currency and have the ability to take on debt in a centralized way. So to facilitate this, there needed to be like this central clearinghouse for all of this activity. In our public education episode, we even talked about the rigorous debate at the time over how they would fund things like national education, among other initiatives. Now, the new country didn't have the money to do everything that everybody wanted, So things like education were kicked to the local and state level, while the common defense of the nation and the ability to raise money to pay off debts was left to the federal government. Now, sure enough, this would be tested multiple times throughout our history, even as early as the War of 1812, and then again with the Civil War, which gave rise to the 14th Amendment. So if we were going to heal as a nation and once again be able to pay our war debts, we needed to ensure to foreign and domestic investors alike that the U.S. word was its bond, a Treasury bond, to be more precise. But the Civil War didn't mark the end of tests to the financial system. There were multiple shocks throughout the Second Industrial Revolution that caused panics and depressions, but we still managed to pay our debts. And then the First World War brought us to the brink, but it was creative financing from industrial tycoons and loans facilitated by none other than John Maynard Keynes, that's how he first became famous, that kept both the United States and the United Kingdom solvent after the war. And then came the market crash and the subsequent depression. A combination of debt financing, debt restructuring, and bond issuances kept the U.S. afloat during this period and allowed us to build a wartime economy that positioned us as the strongest financial nation in the world coming out of World War II. That's why Bretton Woods was such a pivotal moment and turning point in the world. Because the finances of the rest of the world were decimated and gold stores were depleted among participating nations during the war, Keynes led a team of ambassadors, financiers, and diplomats to establish a new world economic order with the US dollar as the foundation. And from that point forward, when the world needed to invest money in a rock-solid instrument with guaranteed returns, the U.S. Treasury note became the true gold standard. And that was part of the catch. Even though we retired the physical gold standard, meaning that every country had to maintain a reserve of actual gold tied one-to-one to the amount of currency that it had in circulation, the Bretton Woods system tied the value of the U.S. dollar to the value of gold. So no need to hold it one-to-one. That's just how money would be priced. It allowed the United States to issue more debt through treasuries and currency in circulation than it had in gold. And that's what allowed leverage in the financial system to develop the industrial and trade economy across the whole world. Money was unleashed in dollar denominations, but still tethered to a physical store of value. So the yield on a treasury bond is kind of a measure of confidence in its own way. Short-term treasuries, by the way, are referred to as notes. Long-term treasuries like the 10-year are referred to as bonds. That's just in case you hear them referred to differently. That's usually what it means. So if we think about the treasury bond as an investment, then the amount that it pays out makes a little more sense. So if the payout on a 10-year bond is really low, it means that the world expects the economy to be stable and that there are other places they can go to put their money to make more on it, right? So if a 10-year treasury bond has a yield of 2%, then it usually means the dollar is strong and places like the stock market might be more profitable. Now, other countries still like the U.S. Treasury bonds even in that low yield case because it means they can convert their money into U.S. dollars. U.S. consumers like low yields because important things like mortgage rates are tied to the 10-year Treasury as well. So if the 10-year yield is low, so too are mortgage rates. The only downside is that a strong dollar and low yields means that other currencies don't buy as much as the dollar, so it makes goods and services from the United States more expensive. And that's what leads to trade deficits, and that is what Trump is trying to fix. But hang on. Let's go back into history to explain why it will be nearly impossible to accomplish this through tariffs alone as a blunt object. So if Bretton Woods made the US dollar the most valuable commodity on the planet and the baseline for all international trade settlements, it also opened it up to speculative behavior. And that's what happened in the 1960s. Because we were still tied to the value of gold and operated under a strict philosophy of balanced budgets, meaning that we weren't going to run any deficits, the dollar was kind of overheating. So the war in Vietnam, the cost of the Great Society programs, all of these things were beginning to pressure the U.S. budget, which means we had to issue more debt and more money in circulation. And because the dollar still rested on the value of gold, Richard Nixon feared that speculators might undermine the dollar and foreign governments might then demand gold instead of currency in exchange for their debts. And that would further undermine the confidence in the dollar. So he took the surprising and unprecedented step of unilaterally declaring an end to the gold standard and allowed the US dollar to, quote, float. From that point forward, the dollar itself would be the value. And as we covered before, he also instituted price controls to tamp down on inflation and issued blanket 10% tariffs on all US imports. Now, initially, it worked, and job growth and manufacturing surged on the news because Nixon was successful in devaluing the dollar. But as we've covered before, the Nixon shock created havoc in foreign economies. The tariffs caused an inflationary spike within the United States, and there was an oil crisis that added fuel to the fire when oil prices tripled on the first of two oil shocks in the 70s. So to keep pace with inflation, the Federal Reserve tried to squash growth by raising interest rates, and we entered a doom loop of stagflation. And for the record, the difference in the U.S. manufacturing base between 1971 and 2025 is night and day. So while Nixon was successful in making U.S. goods cheaper and more attractive to foreign markets, Trump has a fraction of the manufacturing base to boost here. It simply doesn't exist in the same way. In fact, our number one export is energy, and the energy market is cratering right now. So the only thing he's going to accomplish by implementing tariffs is raising prices on goods purchased inside the United States by the U.S. consumer. But I digress. I give you this history again to illustrate one thing. There is no safety net when it comes to the dollar. The dollar is the value. The dollar is the economic foundation of the world. So now go back to our correlation problem that caused everyone to freak out last week. An increase in the 10-year Treasury yield means that investors could be losing faith in the long-term economy. So it also means that borrowing for homes and cars will be more expensive on top of the tariffs that are about to make everything else more expensive. And that leads to kind of the insecurity that everybody feels. And it means that they believe equity markets will also decline and recessionary pressures will make it hard to find safe havens. So this is why pundits call these times a flight to safety. Investors want less risk and guaranteed returns until such time as the market cycle turns over and the stock market starts cranking again. Now, there are other factors, but for our purposes today, conventional wisdom states that inflation expectations drive increased yields in U.S. Treasuries because investors want a higher return. Fine. What we're seeing now is whiplash. Inflation is still on the rise. Even though core inflation backed off slightly last month, we know that tariffs are going to push inflation even higher. So the yield on the 10-year Treasury is being pushed higher to match inflation expectations. Fine. But this also typically means that the dollar strengthens in conjunction with these moves because you need dollars to buy these treasuries. That's why the U.S. is unique. But last week, that's not what happened. Instead, there was a sell-off of the dollar as investors flooded foreign stock markets and currencies. This is why you might have heard the term bond vigilantes thrown about recently as well. This is a term coined in the 1980s by an economist named Ed Yardeni to describe investors who sell bonds in bulk to send a message to the issuing government, us, basically saying, we hate what you're doing, now stop. It makes more sense now why the stock market, our trade partners, retaliatory threats, the finance news channels, or even Elon Musk, these weren't the ones who spooked Trump and his team. It was the bond market. Because the bond market is the market that bets on the two foundations of the global economy, the dollar and the faith that our debts will be paid. Remember, there's nothing after the dollar to hold this all together. There's no gold standard. There's no physical collateral of any kind. Just the promise of a nation to repay its debts. Backstopping the dollar is nothing more than our word and a promise tucked away in the 14th Amendment. The only stated promise of that amendment not yet broken by the one man who is trusted to uphold the integrity and intent of this promise. The very man who has broken every promise, every covenant in his personal life, his professional career, and the duties of the office he holds. In the coming days, we're going to tackle a few related issues to illustrate how Trump's recklessness is going to keep driving the U.S. economy into the ground. And we're going to talk about leverage, repo markets, speculation and short selling, crypto, and how the 1% crushes it during cycles that crush the working class. So make sure you're subscribed to the channel to be notified when these drop, and visit unftr.com to sign up for our free weekly newsletter. For now, the takeaway here is that, believe it or not, the entire global economy is built on these words. The validity of the public debt of the United States shall not be questioned. The only provision in the 14th Amendment that has yet to be undermined and broken by this administration. What you saw last week was the investor class at every level question the veracity of this very statement. So strip away the fancy language, the veneer and professionalism and the jargon, the tickers and pundits, the pomp and the circumstance. This economy is built upon our word as bond, and that bond has been broken by one man and one man alone. Here endeth the lesson.
This is the story of a political pundit who looked at the world around him and just said, fuck it. Gives the middle finger to authority and says, kiss my ass. But instead of a revolution, he started a podcast. Just what the world needs. Started a podcast. Another basic white guy who started a podcast. But it's fun because he curses all through the podcast.